Hey guys, welcome back. In today's video, we are talking about the AMC manipulation, the short stress increasing, the fear of margin calls, and many more in this video. First, we're taking a look at this. This is why AMC's price won't move. 81.7% of AMC trades are happening off exchange. It causes dark pools where Wall Street hides buying pressure from public markets. When retail investors buy, those trades don't hit the open exchange. So the price barely moves even when demand is huge. And so we've always talked about this. By now, everyone, at least people who watch my videos, should realize what is going on, the use of dark pool and how it steals value away from AMC. Now, we've always shown in terms of, at the end of the day, what the dark pool is like. And we're looking at 78%. We're looking at 18.3 million volume hidden away. But we have to truly understand how it doesn't just affect at this one particular moment, but how AMC is suppressed throughout the whole day. So I want to show you guys a few screenshots of at different times of the dark pool usage. You can see here, firstly, at 10:25 a.m., so just an hour after the market has started, we are already seeing an 80% dark pool usage with 4.6 million volume being hidden away, with only 6.41 hitting NYSE at 373,000. So this is an hour after the market has started, even less than just by 5 minutes, and you are already seeing the dark pool usage. But then we're going towards 10:55. So this is now 30 minutes afterwards of where we are. We're then looking at 81%, 6.5 million volume being hidden away with only an increase of 450,000. So you can see the difference. 373,000 going into 450,000 for the volume that's hitting the lit exchange. For the volume that's not hitting the lit exchange, for the volume that's going into the dark pool, we're looking at 4.6 million turning into 6.5 million. So an increase of around 2 million shares at 10:55. Bear in mind, this is only a change of 30 minutes. And then you're looking at this one here, 11:45. So now almost an hour afterwards, you're then looking at 84% in the off exchange with 8.8 million volume hitting the dark pool. And now the volume for NYSE, 491,000. So within an hour, you're looking at how the off exchange has gone from 81% to 84%. You're looking at how the share volume went from 6.5 million into 8.8, a change of 2.3 million shares. But then the things that matter, the things that actually would have an effect on the price of AMC, the volume that's hitting the NYSE, 450,000 in an hour's time, we're only seeing an increase of 41,000. So to what understanding is essentially we're looking at 41,000 shares out of the millions of shares that's being traded to then actually have an effect on AMC price. Bear in mind, we're looking at millions of shares traded already because we're already seeing 2.3 million go into the dark pool. And then you then look at 12:55. So now this is almost another hour after 11:45. We're looking at 12:55, 84% still. 12.2 million volume in the dark pool, and what we're looking at is 616,000. You can see retail is getting sidelined again. Who's fed up with dark pools hiding the action? So 84% off exchange, 4.21 NYSE. You can even see here actually a decrease after an hour because we're looking at 4.69 into 4.21, and then only an increase of around not even 200,000 shares, 130 kind of. And so this is what we're looking at. And then 8.8 million go into 12.28. And then finally, we end the day. You can see we end the day at 78.96%. So a slight decrease because we're going from 84% into 78.96. But we're looking at 18.3 million volume in the dark pool, only 1.4 million actually hitting NYSE. So by now, you should understand just how much volume, just how much action is truly being hidden away. And this is something that we are seeing on the daily. And I hope this clears it up in terms of when you look at it in terms of going throughout the whole day, not just at the end of the day, but throughout the whole day, just how much volume. Because it's not just one big block of order that's being hidden, it's throughout the day, we're constantly seeing how the volume is being stolen, how the volume is being taken away, and not actually having an effect on AMC's price. So now we should understand the manipulation that is going on. That's why we always talk about how we need dark pool to either have more regulations or stop being exploited and abused by these institutions to take away the volume of AMC, to take away the value. So when we talk about how AMC is undervalued, how it doesn't actually reflect what the buyers of AMC thinks, whether it's the institutions, whether it's the retail, is because of things like this. And then you can see how other cases of how right now the market is trying to protect the short sellers. We can see here, UK to stop disclosing identity of stock market short sellers. Now, this is only in the UK, and for me, this is quite surprising considering the fact that UK was a place where they were looking out for naked short sellers. And now, of course, not as much as South Korean markets or some other Asian markets, but definitely more than the US. And now for them to see them do this to stop disclosing identity of short market short sellers, you start to think that something is going on. Now, it doesn't matter that much to us because we've already known who the typical short sellers are, but it's the fact we're seeing how regulations are still trying to protect these short sellers. And then we're looking at potentially why all of this is happening. So firstly, we're seeing the fact that if we're looking at such a high usage of dark pool, if we're looking at regulations to help short sellers, it's because they are not in a good position. It's because they're worried for what's to come. And we can see potentially this is the reason why. Firstly, breaking, US banks borrow $8.4 billion from the Fed standing repo already before market open today. This is a clear sign there is no cash on the sidelines left and stress is increasing. Now the question is, how fast will banks will hit a 500 billion cap on this facility? So what we are looking at is how constantly banks are, of course, lending out money to institutions. And we've seen how certain institutions would then require even more loans because of their over-leveraged positions. And this has caused a whole cycle of them banks needing to borrow more money to then lend out to these institutions who then create even more need, a bigger demand for capital allocation. And now as we see this problem being dragged out, what we're looking at is how the stress is increasing to the point where what we could possibly see is how banks will no longer have the money to issue out. Banks will no longer have the ability to help these institutions over leverage their positions and ultimately go on to what we talk about in terms of the fact that if they are facing an illiquidity problem, if they're seeing stress increasing, we're going to be looking at the covering of shares. And this is what we talked about. Psychology shift from FOMO to fear of margin calls. Where asset prices decline, leveraged positions face immediate pressure from multiple mechanisms. The margin loan risk become particularly acute when markets experience rapid psychological transitions from euphoria to panic. And so this is right now what the problem is being talked about. The risk of the fear even of margin calls. Now, considering how right now the media is trying to portray the market is doing extremely well, which of course, if you look at the results, it is, but there has been signs already, there has been caveats of what's about to happen, where people talk about the AI bubble, whether it's the margin loans like we talked about here. There are so many things, there's so many problems that are all flashing red right now. And so this is why we're looking at the fear of margin calls. And so in a time like this, when you are looking at fear of margin calls, the biggest things you want to make sure is that your leverage positions are able to have the margin, to have the liquidity, to obviously make sure that it's still standing, to make sure that it's still healthy. And so you can see where I'm getting at with this. In a position, in a time where fear of margin calls is becoming a massive thing, where people are worried about margins, we're seeing how the stress is decreasing. We're seeing how there are no more cash on the sidelines left. So what we're going to be looking at is an illiquidity problem during the time where liquidity is needed the most. And this is why we've said how AMC has gotten these short sellers trapped for so long, and we're starting to see the cracks forming, and on top of that, how the cracks are starting to actually break down as well. And this is why we've said that recently we've been seeing the increase, whether it's to protect the short sellers or the use of dark pool. And then we can even see here, so this is for GME. Now GME before the market started today was up 7.12% overnight. And what we're looking at is how this is the max short stretch. So you're looking at times how GameStop is able to run. And now what we talked about is how during these times, when you're seeing AMC run, when you're seeing GME run, and then you see that the news is talking about how short sellers, how banks, how institutions are struggling for money, you start to link the two together, you make the correlation, you understand what's going on. And this is why we've said that margin call is coming very, very soon. As always, none of this is financial advice, so do take it as a grain of salt, which do your own due diligence and research, and I'll catch you guys next time.